I'll start on time. Well, good evening, everyone. Thanks for coming to tonight's seminar. So the topic for tonight's seminar will be SGX Discovery Series with Tiger Brokers, Singapore Market Outlook Amid Global Recession Risks. I'm Joseph from Tiger Brokers, and I'll be your host and moderator for this evening. So we are really thrilled to have you join us at this SGX to explore how potential rate cuts might impact the Singapore equity market, and how the APAC financial ETF and S-REITs can help mitigate portfolio volatility and diversify your portfolios. Now, before we begin, I would like to bring your attention to the ongoing Tiger Brokers and SGX campaign. For a limited time, Tiger Brokers is offering zero commission on trades in the SGX markets till the end of October. You also have a chance to win a staycation at the Fullerton Hotel, $2, a sky dining by the flyer, even tickets to Universal Studios, and many other attractive prizes. So do check the campaign out. Back to the seminar. If you have any questions about today's topic, please feel free to scan the Pigeonhole QR code right here and submit your questions, which will be answered during the Q&A session later on. So without further ado, I have the pleasure of introducing our esteemed panel of speakers who will bring with them a wealth of experience and expertise. So firstly, our first speaker will be Mr. James Ooi, market strategist from Tiger Brokers Singapore, where he possesses expertise from both buy and sell side, and is also an SGX Academy speaker. The second speaker will be Mr. Shin Xiang, ETF business lead from Lion Global Investors, where he has experience in asset management, private banking, and fintech, with the responsibility to drive the ETF business through building and commercializing ETFs. Our third speaker is Mr. Sin Kwan Cheng, Managing Director from Showers Advisors, a seasoned investment manager with 2 decades of real estate experience, specializing in listed equities. And lastly, our last speaker is Mr. Bruce Cheng, Head of Fixed Income from CSOP Asset Management, where he has experience in ETF portfolio management and business development. Let's give them a warm welcome. Well, with that, I would like to invite our first speaker, Mr. James Ooi, to come on stage to start his sharing. Mr. James, please.
Hi, everyone. First of all, thank you for attending this seminar itself. So I'm the first speaker. My name is James Ooi, and I'm the market strategist of Tiger Brokers Singapore. So today, I'll be mainly touching on the rate cut impact on the Singapore equity market itself. Okay, let me talk a bit on the disclaimer first. So this presentation is provided to you for education purpose and sharing purpose only, and does not constitute to any form of advice. Past performance is not indicative of future performance. And initially, I tried to walk on the stage. However, I'm pretty sure that I'll be tripping myself. So, and fall on the stage itself. So I will just constrain myself into the stage here. Okay, I joined the financial industry since 2007. Basically, I have both the buy side and sell side experience itself, and I'm also an SGX Academy speaker. Okay, let's answer the first question first. Why US need to cut rates soon? So basically, I believe most of you will answer to me that Federal Reserve need to cut rate, could cut rate now because of the low inflation data itself. Okay, I want to provide you another set of answer. Number one, I personally believe that the labor market itself is quite weak at the moment. So I like to look at bearish curve to look at the US labor market. So at this moment, if you were to look closely, you can see that bearish curve actually shows the relationship between job vacancy and the unemployment rate in an economy itself. However, the job opening rate is now 4.6%. The unemployment rate is about 4.3% itself. To put it simply, if the job vacancy rate continue to fall, it risks the unemployment rate increasing significantly as it moves to the flatter part of the curve itself. So you do not want to see the job opening rate to go down so much, because your unemployment rate itself, right, may spiral out of control. So this is one of the reasons why Federal Reserve need to cut rate now. The other reason I would like to provide to you would be the rising default and refinancing risk by the speculative grade companies itself. If you were to look at all the junk bond expiring in the year of 2024, it would be amounting to about 150 billion itself. In year 2025, the amount would be 300 billion. So it will be doubling the size itself. And most of these junk bond companies, they derive the revenue from US soil itself, from the domestically. So this is why I would say that they really need to cut rate now to help all these speculative grade companies to avoid any sort of rising default or refinancing risk. Okay, so if rate cut is the way to save the economy, how much should Federal Reserve cut? So we would like to look at Taylor rule. So Taylor rule is an economic principle used to guide central banks in setting interest rate based on the economic conditions. So at this moment, everyone knows that the Fed fund rate at the moment would be 5.5%. According to Bloomberg consensus, the Taylor rule estimate would be 3.73%. It means that Federal Reserve is now about 7 cuts behind the curve. Okay, this is my own alternative Taylor rule formula. I don't want to bore you with details, but basically based on my own assumption, I'll be looking at 3.675% to 3.83%. Mean to say, Federal Reserve should at least cut 6 to 7 times itself. However, what I'd like to share with you is that even though Taylor rule suggests to us that Federal Reserve could cut down to 3.7%, but it doesn't mean that Federal Reserve need to cut the rates today to that rate. It can cut over the 1 year span or cut over the next 2 years period itself. Okay, so and at this moment, a lot of investors are quite optimistic about the rate cut scenario itself because Jerome Powell just said that time has come for Federal Reserve to cut interest rate. Jerome Powell is dovish, but investors should not get ahead of themselves. I simply believe that the rate cut expectations are unrealistic, are simply too high. Because if you look at the moment, according to CME FedWatch, traders are seeing that there would be 100 basis points rate cuts by the end of this year, followed by another 125 basis points cuts in 2025. Mean to say you will see at least 4 rate cuts this year, another 5 rate cuts in 2025. I will say that if Federal Reserve really cut this kind of magnitude, you are looking at economic hard landing scenario. But personally, I do not see a economic hard landing scenario. So this is why, to me, on 18th September, maybe Federal Reserve will just cut 25 basis points once and done for the rest of the year. Or maybe 50 basis points at most. Okay, so this is why I believe that when investors adjust down their rate cut expectations, there will be some volatility in the markets, and maybe there will be some accumulation opportunities as well. And again, a lot of people are questioning whether US is in a recession or not. So one of the rules they will be looking at would be SAM rule. I would say that SAM rule is one of the many recession indicators in the world itself. Personally, I do not look at SAM rule because according to SAM rule, it's now telling us that US is already in a recession. Okay, so what will happen to the STI market after the Federal Reserve first rate cut? Okay, probably we would like to look at the 2 rate cut cycles. We would like to look at 2019 first rate cut and 2007 first rate cut itself. But all of you would remember that in 2020, there would be a COVID crisis. 2007 would be the global financial crisis itself. So maybe the last 2 rate cut cycles do not tell us much because you are looking at economic hard landing scenario. This is why if you were to look at 1 year return, 1 year forward return after the first rate cut, they are all negative. For example, STI index returned 21% after the first rate cut. Financial sectors, including SGX and 3 bank stocks, returned negative 20%. Real estate, including properties and REITs, returning negative 11%, 1 year forward return itself. And REITs index also not performing well, and the APAC Financial Dividend Plus Index also not performing well due to economic hard landing. In the event of economic hard landing, no one is spared. However, if you look closely into the S-REIT Leader Index or the S-REIT Index itself, right, you could see that S-REIT kind of like outperforming other sectors. The 1 year forward return for S-REIT Leader Index was negative 1% only. So it actually provides some sort of protections in an economic hard landing scenario. Another key thing you should know is that following the first rate cut in 2019, S-REIT itself actually delivered positive return and outperformed STI index in terms of 1 year forward return, 1 month forward return, 3 month forward return, and 6 month forward return itself. They're all returning positively. And again, the return in the month leading up to the rate cut was also decent. Meaning to say, if you buy all the things here 1 month before the rate cut, basically, according to history, you can get some positive returns. So the rate cut will happen on 18th of September. So maybe now until 18th of September, right, there are still room to go for some of the sectors I cover here itself. Okay, I want to go down into sectors. Let's look at banking sectors itself. I like banks a lot because typically they are the long-term winners in the STI index itself. For example, in terms of 10-year annualized return for DBS was 13%, OCBC 8%, UOB 8%, beating the STI benchmark index 4.4% itself. And if you were to look at some of the REITs highlighted in orange color here, you could see that the 10-year annualized returns are also quite similar to the bank stocks 10-year annualized return itself. However, in recent years, in terms of 3-year or 5-year annualized returns, most of the REIT stocks underperform the bank stock itself. So mean to say, there might be some catch up in the performance once the Federal Reserve start cutting the rates. And again, one question you should ask yourself is that, since STI index is returning about 4.4%, how could I manage my Singapore portfolio to return to outperform STI index 4.4% 10-year annualized return itself? Okay, I would say 2 methods. First of all, you need to remember that all the bank stocks account for about 50% of the STI weightage. So to me, one way to outperform STI itself is that instead of having 50% in the bank stocks, maybe you want to have 60% or even 70% if you really like bank stocks, and then you are betting on bank stocks to outperform STI in the long run. Number 2 method is that instead of having 50% weightage in the banks, maybe you want to cut down your exposure 30% or 40%, but you probably would like to invest more in REITs, having a lot more exposure in REITs, because the rate cut scenario should be conducive for the REITs index itself. And again, I also like to highlight here is that in terms of 3-year annualized returns for iEdge APAC Financial Dividend Plus Index, it was returning 13%. So the return was quite good to me. Okay, next, I like bank stocks because banks' valuation itself are not demanding. If you were to look at OCBC PB ratio, is trading at 1.15 times. It's about 0.5 standard deviation below the 20 years average. So it's still quite inexpensive. And you also want to look at UOB PB ratio as well. It's doing at 1.35 times is about 0.5 standard deviation below the 20-year average. The only one that could be quite expensive would be DBS. DBS PB ratio is 1.59 times. It's about 1.5 standard deviation above the 20-year average itself. But if you have been trading DBS stocks, you should know that the PB ratio is always expensive for DBS. And if you were to talk to some retail investor or institutional investor, they don't really have a favorite. Some would like OCBC, some would like UOB, some would like DBS. So any one of them, to me, is okay. Okay, the third reason why I like banks is because I'm foreseeing a soft landing scenario, not an economic hard landing scenario. So it's definitely good for banks. So imagine, okay, IMF recently just announced a GDP growth projection for Singapore. IMF is expecting 2.1% this year and 2.3% next year. For China, IMF is predicting 5% this year, 4.5% next year. For US, IMF is seeing 2.6% this year and 1.9% next year. This is not an economic hard landing GDP growth number. So to me, you are looking at soft landing scenario as best. Basically, even though banks are cyclical stocks, but let me ask you one question. What if Federal Reserve do not cut rates that much? So the so-called NIM compression would not be that much. And then Federal Reserve cut rate just enough to spur up the loan growth for Singapore markets. And then you are looking at a soft landing scenario, so definitely I would say that it's probably good for bank. Okay, the next sector I'm going to talk about will be REITs. Okay, how lower interest rate impact S-REITs itself? Number one would be lower financing costs. All the REITs manager can refinancing the loan ahead of the maturity date at a lower rate and can even take up new loan to fund their acquisitions. So they can buy more properties at the lower rates to grow the DPU itself. So you'll be looking at higher DPU scenario. And once they cut the rates, supposedly a lot more people are more interested in the properties, and then you will see higher property prices. And the fourth reason would be lower interest rate in those Singapore 10-year bond yield could make REITs, which is having a higher dividend yield payout, appear more attractive itself. Okay, why I like REITs? Number one, rate cuts should stoke a bullish rotation into S-REITs. If you were to look at the past Singapore 10-year bond yield itself, right, in between 2014 and 2019, the average is just 2.2%. But the REITs dividend is about 5.5%, so there is a yield spread of 3.3%. In between 2020 and 2021, Singapore 10-year bond yield is 1.5%. S-REIT dividend yield was doing about 4%, so the yield spread is about 2%, 2.7%. So the REITs total return also went up. However, in recent years, for the past 3 years, you are looking at a yield spread of only 2.1% because the Singapore government 10-year bond was doing about 3% coupon rate itself. However, I would say that with the rate cut expectation, the yield spread could widen again. So this is why it's a conducive environment for S-REIT itself. The next reason I like REITs is because US 10-year bond yield is still trending down in anticipation of rate cut and higher recession risk. So basically, they have a negative correlation between the REITs index and the 10-year US Treasury itself. So as long as the US 10-year bond yield continue to go down, REITs can really start outperforming. And again, the S-REIT average gearing ratio is about 39%. They can actually buy more properties and potentially increase the DPU. Fourth reason would be the valuation itself still look quite cheap. The REIT's PB ratio is about 0.94 times. It's still about -1 standard deviation below 15 years average itself. So again, I would like to stress that you like REITs because what if Federal Reserve really cut the rates that much? They cut too deep, so I would say that it will be conducive for a REITs investing environment itself. Okay, that will be all for me. Thank you. And now I'll pass the mic to Xin Xiang. Thank you.
Good evening, everyone. Thank you for joining us today. Thank you to Joseph for introducing me, and thank you to SGX for allowing us to use this wonderful venue to speak with all of you. I'm Xin Xiang from Lion Global Investors, and you can call me the ETF guy at Lion Global Investors, for easy to remember sake. So today I'm here to share with all of you about the Lion OCBC Securities APAC Financials Dividend Plus ETF. And before I start, there are things I want all of you to remember. It's very simple, two key things about this ETF. First, it is the world's first APAC Financials ETF. These are important because later I might have prize giveaway questions also. So just remember, the world's first APAC Financials ETF. And the second is that it offers stable dividend yield of at least 5% per annum. So two things, world's first APAC Financials ETF, and second, 5%. Remember, look at your hand, you see 5 fingers, 5% per annum stable dividend yield. And before I talk too much about the ETF, maybe I give a brief introduction about LGI first. We are part of OCBC Group and one of Southeast Asia's leading asset managers. So today we manage around 69 billion of assets for our clients. And we started our ETF journey in 2017 when we listed our first ETF, which was the Lion Philippe S-REIT ETF. So we started back in 2017, around 7 years ago. And since then, between 2020 to 2022, within 18 months, we listed 3 ETFs, which is the Hang Seng Tech ETF, China Leaders ETF, and Singapore Low Carbon ETF. And earlier, just in the past few months, we relisted 2 ETFs on SGX, which is the Lion Nomura Japan Active ETF, which I recognize some of you among our audience who attended my seminars, and also the APAC Financials Dividend Plus ETF, which is this ETF that I will cover. And if you apply the cutoff, right, as of the end of 2023, you will notice that actually 3 out of our 4 ETFs back then achieved the top returns in the whole year of 2023 among the REIT ETFs, China Equities ETFs, and Singapore Equities ETFs in 2023. So all these were data provided by SGX. In terms of our ETFs, we are also among the top 10 ETFs held by retail investors, by everyone, including myself, and also by SRS investors, where we rank among the top 10. In terms of trading turnover in the whole year of 2023, our ETFs also rank among the top 10 ETFs. And all these are because we are a homegrown Singapore ETF issuer. We are part of OCBC Group. We are Singapore domiciled, Singapore incorporated. So because of this, we build our products and our solutions for Singapore investors, like everyone here and also myself. And that is why, because of this, we wanted to provide investors a different avenue beyond the existing products we have. And that's why we decided together to launch the Lion OCBC Securities APAC Financials Dividend Plus ETF this year, because we were already expecting a lot of interest rate movements and changes. So because of all these, might as well, we bring this ETF and list this ETF and launch it with speed. And that's where this ETF was born. So in terms of the financial sector, I'll give a brief introduction. It includes companies that provide services and products that focus on the growth, storage, and transaction of money and assets. So this is important because you notice that actually money started throughout history from seashells and go and evolve until what we have in terms of pay now and also even central bank-backed digital currencies. And all these are important because the financial sector has continued to prosper throughout centuries and is an essential capital provider for economies worldwide. So this part is important. Essential capital provider. So if you are an essential capital provider, you are always the one providing capital. And if you are always the one providing capital, there's some influence on the growth you have, not only on economies, but also on yourself. And when we think about the financial sector, it's not just about banks. There's also investment management, for example, like Lion Global Investors, insurance, for example, like the different insurers we have seen a lot of consolidations happening within this sector to achieve greater economies of scale. And also brokerages, like our partner Tiger Brokers here, and exchanges, where we all sit, which is SGX. And this is important because the ecosystem helps to smoothen the flow of capital across various countries, across borders, and enable economies to trade and function well globally. And when we talk about financials, some of you might be thinking, hey, actually, why APAC financials? There's also US financials in so many different countries. So APAC is a very interesting region, which I want to cover. Key things, in terms of the financial sector, is really one of the world's most profitable sectors, generating trillions in terms of revenue globally. And within APAC, the key fundamental thing that is different, that makes it different from a lot of other regions, is that 55% of APAC adults, this is actually based on a lot of data which we dug out from different reports, different renowned research reports. 55% of APAC adults are underbanked. And this is actually the greatest number in terms of percentage across different regions. And with this huge amount of underbanked adults, APAC financials actually have a lot of room to be able to grow, to serve the underbanked within these different countries and regions. And another special thing about APAC is about high savings rate, which is already higher compared to the world's average. And within Asia Pacific, ASEAN and Singapore actually are the key drivers behind high savings rates within APAC. And key thing is that you will notice that among the world's top 30 banks by assets, only around 14 of them, which is around 50%, come from APAC. There's still a lot of room to grow within this region. And the fundamental thing is that high savings rates within APAC helps to provide further capital to support growth and also improve economic resilience. And within APAC, you will notice that the financial sector is a huge diversified mix across developed markets, for example, like Australia, Singapore, Hong Kong, and also developing markets, which you will notice Indonesia and also Malaysia and Thailand. And the key thing about APAC financials is that they typically pay high dividends. So this is important to lay the foundation for stable dividend income. And when we talk about financials, remember I mentioned it's an ecosystem. It's not just about banks, also about insurance, which is actually one of the faster growing segments within this space. You notice that the life insurance industry within APAC was already the world's largest a few years ago. And there's expectations of further growth of around 5 to 10%, even among markets, for example, like China, India, and Singapore. So all these are expected to further grow within APAC. And this is a high growth segment, which we expect to further grow in the next coming years to come. And when we look at the ETF's name, you will notice that it's Lion OCBC Securities, APAC Financials Dividend Plus ETF. So some of you might be asking, hey, what is in the plus? So I'll share the plus. 3 key catalysts. First is about cushion profitability. So you'll notice that in the past few years, actually banks globally, due to all the rate hikes, have posted decade high profits. In terms of sector ROE, the 2023 sector ROE, which is really expected to reach more than around 13%, which is amazingly much higher than the 14-year average, which we'll notice, which is around 9%. And during this scenario of rate cuts, which James already aptly described earlier, during this kind of scenario, well-capitalized banks are more likely to maintain profitability. So this is a key part about well-capitalized banks being more likely to maintain profitability. And because of this, it is important because of all these fundamental changes that we are witnessing within the global economic landscape to choose and look at well-capitalized banks, which tend to be more large-cap banks. So it's one key thing to note. Second would be the tilt towards Asia. When we talk about Asia, key wealth transfer is happening. Global wealth is expected to reach more than $500 trillion this year. And this is nearly 5 times of global GDP. And this biggest wealth source is expected to come from APAC, around 40%, meaning it's around $200 trillion. And this rise in APAC wealth will be important and crucial to catalyze the growth of APAC financials. And the third catalyst will be the APAC financials' gradual pivot towards capital-light models. So to put into perspective, capital-light models tend to use much less in terms of balance sheet, but they actually generate much more in terms of return on equity and also on income. So technically means lower investment, but higher return for this kind of activities, especially in capital-light models. So for example, in the past 6 years, transaction activities use around 16% of capital, but they actually brought around 33% of profits to APAC financials. And financial institutions right now are also digitalizing and incorporating more and more AI within their business models. All these are expected to help increase efficiency. And so much so that DBS, which is one of James' favorite stocks just now mentioned, that digital customers are consistently more valuable with an increasing share of income. So this is important because it comes hand in hand, well-capitalized banks, and also going capital light, going digital to improve profitability. So all these tie together, well-capitalized banks more likely to maintain profitability. And then going digital light, going capital light and going digital to improve profitability. I'll pause here. I'll have a prize giveaway question right now. Very, very simple, fastest finger. So I'll have many questions. Maybe this time I'll start from the back. How many catalysts did I just cover? Yep, this gentleman. Yep. So you receive a magic pen. You can use it to write out your investment journey. So I've covered 3 key catalysts. And these 3 catalysts are important because they are long-term catalysts and they take a lot of time to be priced in. So, and with this happening, actually, you will notice that actually APAC financials are still at a relatively attractive entry point right now. So if you compare to the national benchmark, our national benchmark, in terms of price to earnings, is actually less than half in terms of price to earnings, around 11 compared to 23. Price to book, 1.1 versus 1.5. It's demonstrating an attractive entry point for a lot of investors. And it's precisely because these 3 catalysts, they take time to be priced in. And some of you might also ask, oh, US rate cuts might be coming. James already used Taylor rule to predict that some of the rate cuts might actually be coming. So if this really comes, what will happen? How will this impact APAC financials? So remember at the start of my whole presentation and discussion, I mentioned that the financial sector is an ecosystem that reacts with different businesses, that reacts differently to interest rate cuts. So this part is important. Different businesses, they have different sensitivities to rate cuts. And second, actually when we talk about US rate cuts, all these could actually drive more investment activity by redirecting more capital towards insurance, towards wealth management. You notice that, for example, in DBS, in terms of their net fee income from their wealth management business, it reached a new record high. So in Q1, it reached 1 billion Sing dollars. It then reached in Q2, 1.05 billion Sing dollars. And this is just by expectations of rate cuts happening. The real rate cut hasn't even happened. And next, also for banks and financial institutions, they are also more sophisticated. They have already protected a lot of their net interest margins. by placing around increasing positions in longer-term fixed-rate assets. For example, DBS already took on 30 billion of fixed-rate assets back in Q3 and Q4. And all these actually help to contribute to its high return of equity of around 18% as of Q2. And when we talk about diversification, sometimes it's not just about sector diversification. It's also about geographical diversification. So in Singapore, a lot of us, when we think about banks, think about financials, think about the 3 local banks. But compared to actually just solely only buying Singapore banks, this ETF actually is interesting because it offers geographical diversification. Because it covers constituents that are listed in countries being at different stages of their interest rate cycle. Sounds very long. One example, Japan. So while the whole world is waiting or bracing themselves for US rate cuts, Japan actually already lifted its negative rate policy back in March, and then recently raised interest rates in July. And then after that, all these are actually expected to increase the net interest margins for Japanese financials. So we don't look at things just within Singapore, but actually across the region, there are a lot of different moving parts and a lot of different hidden opportunities. And this is what geographical diversification can provide. Cover constituents listed in different countries at different stages of the interest rate cycle. So one key example is that the group CEO of Sumitomo Mitsui Financial Group, recently in his investor presentation which just happened around 2 weeks ago, mentioned that net interest income is expected to increase by 100 billion yen in this fiscal year. 100 billion yen in this fiscal year by the Bank of Japan's policy changes. March is the negative lifting of the negative interest rates. July was the rate hike. So all these are expected to benefit Japanese financials. So we need not just look within Singapore, about Singapore banks, but look at APAC in terms of the grander scheme of things, and look at it as a way to geographically diversify your portfolio. And to summarize, the financial sector is an ecosystem diversified across geographies and businesses. And because of all these, it has prospered throughout centuries. And that's why, to help investors geographically diversify and also diversify across sectors, we launched the APAC Financials Dividend Plus ETF. Right now, this will be my next prize giveaway question. In the middle, simple question, yes or no only. Is this the world's first APAC Financials ETF? So this gentleman. Yes. Yep. Okay, he also needs a pen for writing his investment journey. Yes. This is the world's first APAC Financials ETF. In terms of the index, it tracks the iEdge APAC Financials Dividend Plus Index, which actually tracks the top 30 largest and most tradable APAC financials, and helps investors, and is designed to help investors get access to stable dividends. How? In terms of the index criteria, you notice in terms of eligible sectors, banking, insurance, investment services. The last one is something special, specialty finance and services. So this is where actually a lot of the digital banks, for example, like Mari Bank and a lot of the digital banks like GXS, like those with parent companies like C and Grab, those which are more growth-oriented. These companies are actually parked under specialty finance and services. So this is the aspect that makes this index future-proof. So if they grow large enough to pay dividends and become cash cows one day, they could be included into the index. So this is the aspect that makes it future-proof. In terms of the index selection and weighting, remember the 7% single stock weightage cap to ensure diversification across stocks, and also a 20% country weightage cap. And this is where the geographical diversification kicks in. And in the end, what you get is a portfolio of 30 constituents diversified across geographies, and semi-annual rebalancing happening in March and September. And these are the key features about this ETF, and make it very easy for you to remember. It helps you focus on income and growth. Focus on income and growth. So focus on the top 30 largest and most tradable APAC financials. Income. 5% per annum quarterly distribution. In terms of growth, potential capital appreciation within the APAC financial sector. And since the ETF was listed in 13 May, we have achieved around 6.9% return. During this period, actually in July, we also paid a 3-cent special distribution because it actually reached an intraday high of around 1.09 back in 5th of July. 5th of July was less than 2 months after listing. We noticed it reached 1.09 in terms of intraday high. And after that, we announced the 3-cent special distribution in July to reward investors and help investors lock in capital gains. And earlier this month, we also announced our first quarterly distribution, which was at 1.25 cents. Same thing, we are committed to sticking to this 5% per annum quarterly distribution track record and also help investors and reward investors and help investors lock in capital gains through special distributions when we see potential in terms of opportunities or movements. So it's to help investors lock in capital gains. And that's why we are able to achieve a 6.9% return, even within just around 3 to 4 months, if you work, like what we have noticed. So basically, in short, perform well since listing. In terms of diversification across sectors, and also across countries. You will notice none of them is more than 20%. These two are, if you round down, is still 20%. So diversified across 6 countries. Right now, I'll pause here for another prize giveaway question, maybe this row. How many countries is this ETF diversified across?
6.
Yes, 6. Diversified across 6 different countries. And these are the constituents for this ETF. You'll notice that the 3 local banks, which James actually mentioned earlier, are also within the top 5 constituents here. And there are also other financials, for example, like the Japanese financials and Korean financials. So Japanese financials are important because when the whole world is embracing for US rate cuts, Japan is one of the few regions and countries that's actually gradually increasing interest rates. Then in terms of performance, I mean, the 3 local banks have performed well, but if you look at the Japanese bank, it has performed around 8% in terms of since the listing period, and there's a lot more room to happen when there's future rate hikes. So right now, pause here, maybe on this side, have another prize giveaway question. Actually, it will be 2 combined into 1. So I'll be deep diving into 2 constituents. Actually, this row very lucky. Only very few people to go and snatch for 2 prizes. I'll talk about 2 constituents. One Japan financial, one Korean financial. The Japan one starts with S. Does anyone decide want to? Wow, I haven't even say want to answer. You already raise your hand. Okay lah, 就是你了. What? Yes. One of the constituents I'll cover will be Sumitomo Mitsui Financial Group. Also same row. Another constituent I will cover starts with K. Does anyone want to answer? Okay, yes. Yes, KB Financial. So I'll talk about Sumitomo Mitsui Financial Group, which is one of Japan's mega banks, and also KB Financial, one of Korea's largest financial conglomerates. So for Sumitomo Mitsui Financial Group, you'll notice that actually share price between January 2023 until August 2024, you will see a significant rise within share price. So it's an amazing counter that has delivered strong growth, being a mega bank and also delivering economies of scale and also strong growth. And so much so that in its recent investor presentation, the group CEO already mentioned that net interest income is expected to increase by 100 billion yen due to the BOJ's policy changes. And in this quarter, once again, last quarter you also achieved record high. This quarter even achieved another record high in terms of our consolidated net business profit, around more than 400 billion yen. and also more than 300 billion yen in terms of bottom line profit. And all these are because of higher loan income. And to put in perspective, something interesting is that in the previous fiscal year, it had around 58 trillion yen actually parked at the Bank of Japan's current account. Back then, interest rates were very low, maybe even zero. But just at the current interest rate, they already can earn interest income of around 58 billion. 0.1%, they earn 58 billion. And this is already 6%. This was already 6% of its 2024, the previous fiscal year bottom line net profit. So if it increased by 100 billion, so this will become around 158 billion yen. So you just basically park your money there, collect interest income. So this is what actually this Sumitomo Mitsui Financial Group can afford to do. They also reinforce their ambitions to reach 1 trillion in terms of bottom line profit by this fiscal year. Interesting company. Next company will be KB Financial Group, achieve a record high gross operating profit. So you will notice that, wow, the previous one also record high, this one also record high. And in 2020, for KB Financial, they are an interesting company because they also have two insurance arms. They acquired Prudential Financial's Korean insurance arm for around $2 billion US. So this was this period, around effective. So since then, the share price also grew significantly. You'll notice it's around 80+% during this period. Interesting. And between the last 4 years, it actually grew its net profit at an average rate of around 8% per annum. It's an interesting company. And another thing is that, which was announced in its recent board resolution, is that it already announced, for example, earlier part of the year, 320 billion won in terms of share buyback in February. And then after that, in July, they announced another share buyback of 400 billion won. So total is like 720 billion won of share buyback to boost share price. This was approved by the board, and just this year alone, 720 billion won in terms of share buyback, share cancellation to boost share price. And as of June, it also has the highest CET1 ratio. So it's important because remember I mentioned earlier, in the earlier part of the presentation, that well-capitalized banks are more likely to maintain profitability. This is in fact the most and highest capital equity tier 1 ratio, CET1 ratio in Korea's domestic market. And much, much higher than the Basel III regulatory requirement. So in summary, remember 3 key things about the ETF. It helps you focus on income and growth. Focus on the top 30 largest and most tradable APAC financials. Income, 5% per annum quarterly distribution, and growth in terms of the potential capital appreciation in the APAC financial sector. I will end with 2 key things. Remember 2 key letters. To reinforce your memory, I'll make it a prize giveaway question. Do I still have prizes? 1 only. Okay, then I will ask 1 counter only. Okay, very easy. What's the Sing dollar SGX ticker for this ETF? Maybe in the middle. YLD. Yes, YLD. So thank you for remembering YLD because it is the short form for yield. So remember 5% per annum quarterly distribution is a good yield. And you remember to log on to the Tiger Brokers app to buy this ETF, YLD. Thank you. I'll pass the time to my next speaker.
Hi, good evening. My name is Casey. I'm from Sora Advisors, and we are the sub-advisors to the CSOP iEdge S-REIT Leaders Index ETF. I run investment strategy for Sora Advisors, majoring in listed real estate equities. I've been doing this for about 15 years, both on the sell and the buy side, covering the Asia-Pacific region. Shore Advisors is part of Shore Capital Group, who is a professional investment management firm that helps family offices, ultra-high net worth individuals, institutional investors manage their real estate, wealth, and investments across both public and private markets. I would like to start by thanking James, the earlier speaker, for rightly spotting that S-REIT is a laggard catch-up play. So I'll share more with that with you in the following presentation. I'll start off by illustrating some of the characteristics of the S-REIT market, followed by an update of the key factors that impact them, and why S-REIT should outperform despite the 12% rally off the bottom this year, roughly about 2 months back. S-REITs are, you can see from the center pie chart that they are predominated by industrial, logistic, data center, and business park, about half the portfolio. Sorry, it's locked. Sorry about that. Okay. Yep, okay. So these industrial data centers and business park spaces are all new economy real estate, which should future-proof your investments. And the right-hand bar chart shows that we are currently still roughly about half exposure in Singapore, so we are still quite Singapore-centric. This chart shows that bottom right-hand table, if you have invested S-REITs in the last 10 years from December 2011 right up to now, you probably will get a total return of about 8% per annum, make up of about 5 to 6% yield and about 2 to 3% capital gains. So if you are smart enough to sell when the Fed start hiking rates in 2022, you will get an extra 4% capital gains, giving you a total of 12%. So all this shows that, REITs deliver a stable yield with growth. In terms of return seasonality, the best returns from the S-REITs usually happen in the fourth quarter and the first quarter, which is the upcoming 2 quarters. So do take note. This shows the headwinds and tailwinds in 2024, in the last 2 years actually, but you can generally see where the headwinds and tailwinds are. Between 2022 and 2024, when the Fed start hiking rates, inflation and rising interest rates impacted the S-REITs. Growth was curtailed and distributions were slashed. There are a few main factors. The strong Sing dollar diluted overseas distributions. As you said in the earlier pie chart, half the exposure were from overseas. Utilities and operating costs were inflating. Everyone get wage increases, so operating costs went up. But the most important factor was that the rising borrowing costs had a huge impact. S-REITs now currently have the highest cost of borrowing within their books in the last 15 years. But inflation is a double-edged sword. What we have been seeing has been cost inflation. But more recently, I think S-REITs are also benefiting from rent inflation. That's the delayed impact that come about because costs are adjusted monthly and annual adjustments, whereas rental leases are renewed every 3 years. So that is slowly catching up. So like a super tanker, the S-REITs are slowly turning around as interest rates are now currently poised to turn lower. So let's look at some of the factors that are shown on the chart. Singapore economic growth. So if you look at the top left-hand table, manufacturing has been weak, 2022, 2023. But I think in recent quarter, it's showing some signs of life. Electronic companies are quite positive on the ongoing global tech and chips upturn. But Singapore's economic recovery over the next couple of years would likely hinge on the performance of external-oriented service clusters because service GDP are actually quite a huge part of Singapore's GDP. And the outlook looks quite promising as you show on the center and top and center right charts that forward business expectations and credit demand are all turning positive. When the Fed cut rates, there'll be more credit demand coming up, and as a result, that will spur the services sector much more. Inflation has been cooling. The July core CPI was actually quite significantly lower at 2.5%. So now there is some expectation that the MAS may ease in October on its Sing dollar policy and would adjust its net effective exchange rate. Why is this important? As I mentioned earlier, offshore earnings has been diluted from the strong Sing dollar. Between 2021 since 2021 until now, the Sing dollar has appreciated against the euro and pound by about 6 to 8%, 12% against the Aussie dollar, 15% against the Chinese renminbi, and 30% against the yen. When this all did dilute the earnings. So if MAS does ease, then that Sing dollar appreciation will no longer be a drag on the earnings of the S-REIT's overseas earnings. So both these factors suggest that dampeners from the operating cost inflation and offshore earnings impacting the S-REITs should be moving behind them. Now moving on to the S-REIT subsector updates. Industrial supply looks benign and in line with historical demand. The trouble spot would probably be business park vacancy. So if you see that the single user factory, 1.9 million square meter, looks a big number, but actually that's not actually worrying because most of these are owner-occupied and developed or redeveloped by these owners, and so they are all mostly pre-committed. So business park vacancy has spiked, remained elevated recently, especially outside of the city fringe area. The core business parks are usually located in Science Park and the Mapletree Business City, and most of the S-REITs own properties in this area, especially the Sanders and the Mapletrees. These are all doing okay, but outside of that, there's been a flight to core and flight to quality, and because of work from home, so these are impacted. But I think recent S-REITs commentary seems to suggest that the worst might probably be over, vacancy will stabilize, and demand seems to be bottoming in this sector, in the business park space. Office. Net supply looks balanced against historical demand. There's a 1 million square feet completing next year by Keppel South and Shaw Tower redevelopment. But if you look through the next 4 years from 2024 to 2027, beyond 2025, there isn't really much of a supply coming up. So I think the office sector would probably be quite stable looking forward. It's a very similar story in retail, quite balanced. Retail supply coming up, and with tourists coming back, I think that demand supply would be quite absorbed. I talked about rent inflation earlier. So rent reversions have been strong across all the subsectors in the S-REIT space in Singapore, overseas as well. So growing from a low single digits to the low teens now, if you look at the top left-hand corner chart. CBD retail has actually outperformed suburban, the center chart, because with tourists coming back, and some of the leases were done on turnover rents during the COVID period, those are actually in terms of rents. Office reversion should probably stay positive for another year because the in-place rents the leases that were signed during the COVID were low, and now their CBD grade A rent were about $12, so they should be able to renew another year of positive reversion, higher rentals for them. Industrial and logistic reversions were strong as well, but it started to ease since the second half of last year, but it's still pretty strong at about 10% levels. In hotels, that has been doing well because of the tourists returning, high room rates, high occupancies, but there's been some pullback as the revenge travels eases and the Sing dollar is starting to bite. So if you look at the visitor arrivals, the Singapore Tourism Board is targeting about 15 to 16 million this year, up about 10%. But this is still well below the 90 million that we had in 2019 before COVID. So there's still room for further recovery. And in the second half, year to date, half to date, July and August numbers seems to be pretty decent growth from last year as well. So I think they are on track to achieve that 15 to 16 million. I mentioned that S-REIT cost of debt is at the highest currently. So it's currently about 3.5%. And that is likely to peak at about high 3% with another 20, 30 bips coming on. But with the interest rate coming down already, we do expect the borrowing cost to go. So if you look at 3-year swap rate plus another 100 basis point margin as the proxy of S-REIT borrowing cost, you'll notice that the trend is once the spot borrowing rates start falling below the in-place borrowing cost, the S-REITs actually do well. So there are 3 periods highlighted. It shows that there's a quite strong relationship, and currently the rates are already falling below where the in-place borrowing costs are. The Fed is likely expected to cut 9 times by the end of 2025. I think James talked about it as well. So there could be some volatility because 9 cuts is quite a fair bit. And if the inflation stays strong, they might cut less or they might cut more. As a result, I mean, there'll be some volatility. So this is a likely risk that you have to note of when you invest in the S-REIT space. Gearing currently is about 39%, but it's not exactly concerning, even though it's high relatively to history, because recently MAS talked about proposing to lift the gearing limit to 50% with an interest coverage ratio of 1.5 times. But I think more importantly, S-REITs in the last 12 months have been divesting assets at a premium to valuations, average about 14%. So they have avenues to reduce their gearing by selling low-yielding assets to retire their high-yielding cost of debt. And that has been ongoing, so there's no real need for them to do a very large dilutive equity raisings to reduce their gearing. So after S-REIT rallied about 12% off the bottom this year, could we expect more? I'm in the soft landing camp, even though hard landings look soft in the beginning. But this is looking more like the 2019 rate cut cycle than 2007. The recent rate hikes have less of an impact on US consumer and corporates than previous cycles. And I believe they are in a better shape to handle a slowdown. Definitely, if you look at labor data, things are slowing down, but it's a slowdown, it might not be a hard landing. If you look at most US mortgages are locked in at very low rates, the consumers are actually in a good place. Stock markets at all-time high, house prices are high. So in terms of the personal balance sheet, they're not so bad. And with the high interest rates, they're actually earning quite a good interest income. So most consumers are not exactly stressed. The S&P 500 companies, they all have record profit margins, high cash levels. So they do have a buffer to help them weather this slowdown. So in the event, if a slowdown come, would S-REIT be able to hold up better? From the 2019 episode, S-REIT gave a total return of about 10% in 6 months before a black swan event like COVID derailed it. Currently, in terms of valuation, price to book is about 0.96 times, still below the historical average of about 1.02 times. Yield spread is tight, but it has been so since 2022. It will normalize as earnings revisions come through because of lower interest rate, no more cost inflation, and distribution will rise on low rates. If you do look at the historical regression between the risk-free rate versus the yield spread, we are currently in line. So it is not too far off from where the statistical model is. This chart shows the 2019 episode on the left and the current episode on the right. So when they start, when it is starting to price in a lower rate, interest rates, you can see that the yield spread moved from above the line to below the line. And this has happened in 2019 as well. So when earnings revision goes up, it will normalize. And so this is quite in line and natural. Market analysts have yet to revise their earnings forecast up because I think they're still waiting for next week. When the rate cuts start, then they will start revising earnings for next year and the year after. So you will start seeing the gold line, the green line, and the dark green line moving up on the right-hand side. But so far, none has come through yet except for maybe Capital DC REIT as well as K-REIT. And finally, S-REIT is a lagger play versus other REIT markets. So I start off from October 2023 when the excitement came about when expecting rate cut to come through. They all peaked at December and then fell off for the first half of the year. But if you look at it, you can see that Australia, the US, Europe, and the UK REITs have all done well, better than Singapore. So there's quite a good catch-up for Singapore to come through. And We need a local perspective. Since 2021, S-REIT have underperformed STI by 30%. And on an index basis, STI is near a 10-year high versus S-REIT as a near 10-year low. In other words, S-REITs have already suffered a mini recession. So if you look at both the 2007 and 2019 rate cuts, the starting basis is that S-REIT were near 10-year high back then, but we are now starting off the rate cut from a 10-year low, near a 10-year low. And the last point I want to make is that the investor positioning in S-REITs have been quite low for the last 18 months, but that has started to change. Interest has come back, and you can see from the recent strong take-up in the equity raising by CICT, even though Capital Infrastructure Trust is not a REIT, but it's a dividend play, those are all well subscribed. So I think interests are coming back to the sector. With that, I end my presentation today and pass on to Bruce to talk about the opportunity you can tap on to monetize this S-REIT. Thank you.
This is perhaps the easiest presentation I've ever given, since over the past several years, because the market outlook is pretty much covered by the James, Xunshan, and also Casey. And also we are right ahead of this REIT cut cycle, so that we can easily focus on these our CSOP, iEdge, S-REIT leaders, index ETF, and also the PM of this ETF. So in addition to the short-term drivers, it's also quite straightforward to see that the S-REIT, the iEdge S-REIT index, their dividend yield is higher than the STI, and also higher than the fixed deposits in Singapore, and also the risk-free rate, as well as the core inflation rate. And also, as shown on the right-hand side, you can see this kind of high dividend yield is not at the cost of the high volatility. Their volatility is still at a relatively lower range. So the return risk ratio is still very attractive. So I'll leave some seconds for the photo taking for this slide. Yeah, and also even on a forward-looking basis, the inflation is the good part is inflation is already peaked, but the dividend yield is pretty much stable at around 6%, which means that the dividend yield as compared to the inflation is even more attractive in the next 2 to 3 years. This is because the rental growth is also part of the CPI. And for those S-REIT leaders, they have the power to manage a very even faster rental growth versus the generic aggregate inflation. So this is also quite exciting. Now, that's also explain why the S-REITs could outperform most of the major global peers over the past 7-8 years over the comparable periods. And it's also interesting to notify that the over the past 8 years, the annualized total more than 5% and nearly 6%. We can always argue that in the near term, in the short term, the price or even the FX could have an impact on the S-REIT total return. But over time, in the long term, the dividend yield, which is currently for our products, is still annualized around 6%, is the major driver and the most stable driver to the ETF performance. And this, I think, every time I share these snapshots of the benchmark we used, we also use iEdge index, which is issued by the SGX. It includes not only the largest REITs on SGX, but also the most liquid S-REITs on SGX. So the implication here is that since we are right ahead of the Fed's cut cycle, these kind of large and mid-cap focused or liquidity focused portfolio could be the one of the most suitable portfolio for investors to capture the potential rally. So this is definitely a double-edged sword. Over the past several years, we used to suffer from the high for longer environment, but now it's a good time to also or a payback time for these kind of the portfolio. And the large and mid-cap focus also imply that some scale advantage, because it's quite straightforward, as shown on the left-hand side. The bigger market cap or the more liquidity may imply higher valuations, or else equal, and it helps the underlying REITs to raise more equity and also acquire more more projects or properties with a better, strong quality at the current stage. So that's why in the history, the large cap or the larger peers, they could outperform their smaller peers or in the history. And again, also, what's behind those large and mid-cap S-REITs is about the government-linked sponsors. For example, roughly 70% of our underlying holdings, they're sponsored by those GLCs or the government-linked entities. And this can definitely help the underlying REITs to acquire the quality, well-located and dominant assets, and also help them to achieve some operational efficiencies with scale, and even achieve some global outreach. And all of this finally translate into the yield spread advantage, and also create a potential for higher debt headroom, particularly given that the MAS suggests to increase the leverage limit from 45 to 50%, and also lower this minimum ICR requirement from 2.5 to 1.5 multiple. So as we may see a peak of the interest rate as well as the borrowing cost, then this may also help these S-REITs to conduct some overseas acquisition. And liquidity advantage is quite straightforward as well, because it's not super hard for every single individual investors to create your own basket following our benchmark, because we disclose these daily holdings on our website, so everybody can see it. But the trading cost can be potentially higher, because individual investors are still subject to these potential wider bid-ask spread, such as more than 60 bips. But through our dedicated institutional trading desk, we can lower these underlying S-REIT trading to a very, very low cost. So, and this can translate to a much narrower bid-ask spread for when investing in the ETF, like our SRT ETF. And using an ETF can also create some diversification advantage, because anyway, the S-REITs, they're all on SGX. Their geopolitical exposure or their sector exposure are different. So the relatively low correlation can still provide some diversification benefits. That's why our index or our portfolio actually have almost the lowest volatility versus our underlying REITs. And this also translates to a relatively low maximum drawdown in history, as shown on the right-hand side. And in history, the max drawdown is roughly negative 22%. But it's more interesting to see that, as shown on the right-hand side, the yellow circle, not circle, but roughly like that, the rebound, despite the rebound in July and August, we are not as cheap as previous months, but it seems we are still far away from the previous peak. So the rebound perhaps is not done at the current stage. So we can still capture the further rebound potential as the Fed start to cut the interest rate. This is to also echo these James the analysis about the S-REIT's performance before and after this first rate cut. And also, I won't read this line by line, but definitely owning a S-REIT ETF, they have more diversified exposure versus directly buying the property or even by a single S-REIT. And the minimum investment threshold is much, much lower than directly buying a basket of S-REITs by individual investors, because you may spend maybe 3,000 or maybe even 4,000 Sing dollar to create a similar basket, but using the ETF, you can start at slightly less than $1 Sing per share. And again, the liquidity is still quite good, higher than the property for sure, and also potentially higher than the individual S-REIT trading because of the dedicated trading desk. And the dividend yield, the most recent dividend payment, our annualized yield is still around 6%. So this, as compared to the single S-REIT trading, this creates a more stable and more predictable dividend range. And this is our snapshot. Again, I just want to highlight the SGD trading counter. Most relevant to this local investors is SRT, and the board lot size is just 1 unit. We just paid our dividend late August, but the investor should not worry about that, because what's ahead is actually the potential capital gain because of this Fed rate cut. And also our investment advisor is Shore Capital, and Casey is our investment experts behind us. And in terms of performance, on a relative performance perspective, we can still outperform our benchmark by more than 60 pips gross of fees since inception, which means even after fees, we can still slightly better than benchmark. But to investors, it means that you don't need to worry too much about the TER because the outperformance already covered this part, thanks to the tax efficiency as well as the corporate action participation. But from a total return perspective, the recent 1 month, the recent 3 months, the rebound is quite meaningful already, because 2 months ago I was also here at the same stage talking about why should we enter this sector. But if you look at the year-to-date performance or even the long-term performance, which are still in the negative territory, which means we may still have more potential for the further rebound at the current stage. Even we already see some rebound in recent 2 months. So to quickly summarize, as we are right ahead of the first rate cut from the Fed, so using an ETF like our CSOP SRT, the ticker, it can easily help investors to capture or to invest in the large and mid-cap S-REITs, and with a cost tax and tax efficiency. So that's all for my short and sweet presentation. Thanks.
All right. Thank you to all speakers for the wonderful and insightful presentation. We heard some really insightful perspective, especially from Mr. James, Fed interest rate cuts, Mr. Shin Xiang, APAC Financials ETF, and S-REITs from Mr. Bruce and Mr. Sin Casey. Right. So right now we'll be spending the next 10 to 20 minutes or so on a panel discussion and having a Q&A session. We'd like to invite all speakers to come on stage to join this session. Let's give them a round of applause. In the meantime, I encourage everyone to take this opportunity to scan the Pigeonhole QR code if you have any questions about today's topic and participate actively. Testing. Okay, I think you can hear me. Okay, so let's start the Q&A session. I think one of the question is on my slide right here. I hope you can see the question on screen. Maybe not. It's okay. I can show and read out the question to you. I think one of the question is asking, most of my portfolio is in US stocks and I'm going to retire soon, and thinking of moving my portfolio to Singapore dividend stocks. What should be my strategy? Sell off all my stocks at once or DCA? Open to the floor. Anyone want to answer this question?
Yeah, probably I go first. Okay, actually it depends. Basically, right, if you are holding on some quality US stocks, I don't think you really need to sell if they have been performing well. But if you're really trying to move all the US portfolio to Singapore dividend stocks, right, again, I think today all the speaker here is providing you some good ideas itself that can yield you quite good dividend yield itself. Even if you were to look at some of the 3 local banks, they are giving you above 5% dividend yield. So it's quite good as well. And probably the next question is that, should I sell off all my stocks at once or DCA? Again, this is a market timing question. It depends on how good you are with the market timing. Personally, I would prefer DCA if you are afraid of the market volatility, that you are afraid that you may catch it at the wrong price itself. So again, I think this kind of question is quite dependent on what kind of risk profile, what is your skill set with the market timing, and then what kind of sectors you really like. But I believe some of the ETF ideas today actually can give you some of the good dividend yield.
Okay.
You'd like to weigh on this?
Test. Yeah. Okay, for me, from how I see the question about retiring soon, so I assume retiring soon means the risk profile and time horizon will be decreased. So because of this, probably the risk appetite is not so high. So if the risk appetite is not so high, then probably one way is actually instead of market timing, it could be better to or more suitable to gradually instead of timing the market, because in the end the fundamental thing is not really about timing the market, because you sometimes get it right, sometimes you get it wrong, but about time in the market, time within the market. So as long as there's still appreciation and growth happening, probably could be also good. And after selling, you will get proceeds also. Then the next to consider, maybe some questions, because you have US dollar stocks. Then probably you have to consider about how to convert into Sing dollar to buy Sing dollar dividend stocks. So this is also another point of consideration. I'm upfront, I'm not a fortune teller for FX, so this part I cannot comment. And after that, once it's converted to Sing dollar, then the next step is also choosing what to buy. And if you buy single counters, then you have to go through the round of analysis, analyzing different things. So one good way, an easy way to gain simple and quick access could be actually through ETFs, which offers diversification, also low cost, and also liquidity, which some of my panelists already mentioned. So and by buying ETFs, and maybe one ETF that could be worth considering could be the APAC Financials Dividend Plus ETF, because it offers 5% per annum in terms of quarterly distribution. And to help investors lock in capital gains, we may also, like what we previously already did in the past few months, announce special distributions to help investors lock in capital gains. So it could be more suitable to trust the professionals for the ETFs, and also instead of timing the market, gain time in the market, and also at the same time gain access to stable dividends. So, and then the next thing would also be about whether you buy all at once or also dollar cost average. And like what I also mentioned earlier, instead of buying all at once, because one, you have to time the sale. Now, second, you have to time the purchase. So maybe it's too much info to digest, and probably it's easier to do dollar cost averaging. So instead of lump sum, you smoothen out in terms of volatility for the prices and also your entry point. So in short, DCA probably is the better choice to approach things, and also diversify to an ETF to probably gain stable dividends, and at the same time maintain your time within the market. Yeah.
Should I read this? Sorry, thanks. No, it's just a joke. Yeah. I think it really depends on what kind of US stocks they're holding for now, right? If they're holding the value stocks, I think it's still okay. But if they're holding some tech stocks, I won't say tech stocks are not good. They're good, but also with high volatility, because over the past few years, this was mainly driven by the multiple expansion instead of the earnings expansion. But for now, their further rebound will mainly subject to the earnings expansion for the US stocks, or even including the Max 7 stocks. So since the person who asking this question is retiring soon, then relatively speaking, I would say the Singapore dividend stock, including the S-REIT, or S-REIT ETF, they have a relatively low volatility, but still with a decent dividend yield. And also to echo Xunxiang's point is that at least for Singapore investors, investing in the SGD asset is free of these FX risk.
All right, so we can move on to the next question. All right, so I think one of the questions is for REITs, especially for the experts itself. One of the questions asking is, sorry, I hope we can see my screen. Okay, I hope you can see the screen. Okay, one of the questions is asking, over the past 2 years, Singapore real estate has held up better than overseas real estate. Will this trend continue? I would like to weigh on this.
Good question. I think if you look at my slides earlier on, it shows that they are undervalued Singapore assets. Most of the assets they are sold was in Singapore. So they are able to extract a premium to the book values, which means that there's been no distress in the market so far. And I think that will likely hold on, especially when rates are coming down. In fact, I think over the last couple of years when interest rate have started to fall until very low levels. Throughout the world, in the developed countries like the UK, the US, Australia, the cap rates have tightened a lot, 300-400 basis points for certain assets as well. But in Singapore, that tightening didn't really happen that much. So in general, I think office assets were valued at about 3.5% to 4%, retail about 4% to 5%, industrial high 5s to 6-7%. That haven't really changed. As a result, you can see that they were undervalued and they are able to sell that at a higher price. The only exception was in hotels assets. Currently, I think the best assets are selling at about more than $1 million per key. But if you look at the hospitality REITs, they are all trading at 0.6 to 0.7, 0.8 times price to book, which means that they are still undervalued from the S-REIT perspective. And my presentation also clearly highlight that there were very good fundamentals in the S-REITs in terms of high occupancy, high rental reversions, as well as a good demand and supply. So I think that will hold, and I think investors will like them, and as a result, their valuations will probably hold up. But another factor that really affect why people like Singapore assets is that there's a scarcity value, and they're all closely held. So people like because of a stable Sing dollar policy, they like our government, leadership, transparency, British law. So it's very easy to buy and sell in Singapore. Very clearly transparent, nothing hidden. And if you look throughout our competitive markets, Hong Kong, because of China, clearly it's not in favor currently. So nobody wants to go there. And Japan is a very complex market where if you are not a local, it's very difficult to break into because most of the properties are either held or managed by Sumi, Mitsui, Mitsubishi. So if you are not one of them, most people don't really sell it to you or want to do business with you. And it's very relationship based. And even if you are a foreigner trying to borrow money to buy the asset, you are charged a higher price than them because the relationship is very important. And US, complex tax rules, right? Can't figure it out. And it's so far away time zone wise. So nobody goes there. Australia, UK, they are starting to turn inward where if you are a foreign buyer, absentee owner, they heave an extra charge on you for holding the property versus the local. So you don't really have a competitive advantage. So that's why Singapore stands out. And I think that demand for Singapore assets will continue. And lastly, I think if you look at the S-REIT sectors, I think Bruce mentioned before, most of the S-REIT management are either GLC, very good track record. So they like it because they can manage it well. In real estate, if you can manage your capital management very well, you are halfway to getting your returns because capital management is very important. Yeah.
All right. Thank you for answering the question. I think one of the top voted question right now is this question. With the US interest rate going down, how do you think SGD will do? Perhaps strengthen or weaken with years to come? With reference to 2008, SGD strengthened tremendously against USD after rate cuts. Any of the experts would like to weigh on this?
It's really hard to answer the FX question, it's very hard. But I have to say that if you look at the recent years correlations, the US 10-year yields and Sing dollar 10 years are highly correlated, which means they went higher together, they peaked together, and they went lower together. So from this perspective, all else equal, if the Fed starts to cut and also MS, if they also follow a similar trend, then from a yield spread perspective, the change may be relatively small. So from this perspective, you may not see a very, very strong Sing dollar versus the US dollar. But it also depends on how the growth momentum between the two countries. Yeah.
All right. So I think one of the question is towards Mr. Shin Xiang. I think for the Lion OCBC Financials ETF presented earlier, you saw that many China banks is in your listing. What is your view in regards to the current China's economy? Maybe Mr. Shin Xiang.
Yep, no problem. So, okay, you saw many China banks. That's where the country weightage cap comes in. It's capped at 20%. And there are actually various merits about Chinese banks that a lot of investors may not understand or appreciate yet. A lot of the Chinese banks actually pay attractive dividend yields of 7 to 8%. 7 to 8% in terms of dividend yield. But you also notice because in the ETF, we kept the country weightage, China's country weightage at 20%. So actually what you get is a bunch of Chinese banks paying 7 to 8%, but exposure-wise kept at 20%. So actually this overall actually also helps to support the dividend yield of the ETF. And this is actually good for a lot of the investors. You get the best of both pies. There's also the Japanese banks inside, the Australian banks inside, all those are also doing well, have been doing well recently. So I think it's actually not a bad thing for the ETF. And in terms of the broader view about what we have in terms of Chinese economy, I'll keep it briefly. There have been a lot of, I would say, economic stimulus, especially fiscal stimulus and monetary stimulus policies already implemented. And all these are what we expect to be more positive for the Chinese economy. It takes time for it to gradually recover. But what we can say is that it's happening gradually in the correct direction. And not to forget, in the broader landscape, China is also one of the world's largest economies, the world's second largest economy. So for it, because it's already the world's second largest economy, there's a lot of more room. It also has a large population. There's a lot of more macroeconomic foundation within China. And with these stimulus constantly being rolled out, all these are pushing it and nudging it towards the correct direction to eventually recover. And with all this happening, actually China, with all the doom and gloom that people are talking about, actually an entry point in terms of a lot of different Chinese giants are actually quite attractive right now. So probably it could be worth to consider dollar cost averaging, so to smoothen out the various price movements. Yeah.
All right, need to comment?
Yeah, do you want to comment?
In fact, yeah,
please
make
feel
some
free.
comments about help your product, but I'll still try to be objective.
Okay.
Since I'm from China, I think for now, the challenge the Chinese banks facing is definitely the property crisis and also the challenges faced by these LGFV, because we haven't seen a clear rebound or the turning point of this China's property or the local government crisis. But for now, if we solely talk about the Chinese banking sector, I think the risk is still concentrated in those small, mid and small banks and regional banks. But for the big four banks or even some the so-called the JV stock banks, we don't think they have a big problem because of their NPL ratio still relatively low and their CET1 ratio is still quite sufficient, and more importantly, that's directly supported by the central government. So I do believe Junxiang's portfolio, they still hold the high quality banks, including the big four banks. So from this perspective, they should be okay. So give me some bonus after this.
Yeah. Hey, thank you.
All right, so DCA.
Or buy more units in your ETF.
Yeah, so DCA into APAC Financials ETF. Yeah. I think one of the questions most voted currently is, I hope you can see on the screen. One of the questions is asking, does rising uncertainty in the global economy help Singapore? Right, would any of the experts would like to weigh on that? I repeat again, does rising uncertainty in the global economy help Singapore?
Probably I provide a quick comment on that. I mean, if you were to look into the institutional investing world itself, or you look at how the global fund manager view Singapore as equity markets, normally view Singapore as a dividend-paying, cheap valuations, safe haven assets itself, and low volatility. So if you coming from that angle, when there are rising volatility, people may favor Singapore equity markets because there are a lot of cheap valuation stocks, banking stocks, or even the REITs counters inside the Singapore market itself. But if you want some growth stocks, then they will look elsewhere, like they will look into US equity market or the Hong Kong equity markets itself. So if you were to say, with rising uncertainties, with rising volatility, fund manager in the world may favor Singapore market because they view it as a defensive asset allocations.
All right. Thank you for sharing. So I think we have one more question. I'll move on to the last two questions, if you don't mind. Actually, it's more of my personal question. Why do you think ETF has been a popular, vehicle for investors, especially on ETF? And on a more personal note, in my experience, could you actually share with the audience that how do you get to know about ETFs in the first place? Maybe Mr. Shin Xiang would like to share on this.
Okay, sure. Okay. I first came across. Change the mic. I first came across ETFs more than 10 years ago when I used it as a low-cost solution to build my own portfolio. So actually ETFs, what I believe they offer actually three key benefits and advantages. First is low cost. Second is about diversification, because you gain diversification and access institutional kind of quality, kind of opportunities. They have democratized a lot on investing, so I think it's an interesting instrument. And also, the third thing is also about liquidity, because it's traded on exchange. On an exchange like SGX, you can buy and sell even within the same day if you want it. So it's a very convenient, affordable, and also a simple instrument to be able to use. And actually, hand to heart, the first ETF I actually held in my life was actually the STI, the ETF. So because I'm Singaporean, born in Singapore, so the first ETF I held actually was the STI ETF. Over the years, my portfolio has also already evolved to include different ETFs, for example, like the APAC Financials ETF, and also our Singapore Low Carbon ETF that has outperformed the Singapore benchmark, which is the Straits Times Index, since its listing and inception.
All right. I think we move on to the last question. Any other factors that investors need to be worried about when investing in the real estate space?
I think the current main topic is whether there's a recession. So I answer it, I'm in the soft landing camp, but it's a risk that you need to take note where if there's a recession, most assets would not perform well, but some will outperform. And I laid out the case why S-REIT currently will probably outperform most other asset class because of valuations and the fundamentals. And I think the other part is that there's volatility as well. 9 rate cuts, is it coming true? Maybe the Fed thinks that 6 rate cut will be what it is, or maybe they think it's 12 rate cuts. Although I'm not hoping that it's 12 rate cuts, because if they do 12 rate cuts, it's bad. So better not have that. A slow and steady rate cut cycle is more beneficial because it reflects the Goldilocks scenario. Yeah.
All right. So I think we come close to the end of the session. Before we end, actually, we would like to invite each of the speakers to have a quick and concise closing statement, if that's okay. Maybe Mr. James, you'd like to go first?
Yeah, definitely. I would like to go first. I am constructive on banks and REITs. The main investment thesis for REITs to me is that what if Federal Reserve cut rates that deep, cut rates too much? Then I would say that REITs as a high dividend paying instrument itself, right, would definitely inspire more investors to buy and hold on it itself. The reason why I like banks is because they are always the long-term winners among the STI component itself. And you also need to think of one scenario. What if this is a soft landing scenario? And then Federal Reserve do not cut rates that deep. NIM compression was not hurtful enough for bank. And then coming from the angle that Federal Reserve just cut rate enough to spur the loan growth. So I would say that it would be pretty conducive for investing in banks itself. Yeah, that would be all for me.
Okay, for me, because I'm the ETF guy, so I will focus on ETFs. So ETFs, you can think of them like Lego building blocks, mix and match to build your own portfolio. Simple, convenient, affordable avenue. to use it to build a diversified portfolio. So before I end and wrap up, I hope you remember two key tickers, YLD for good yield, and also ESG for the Singapore Low Carbon ETF, which has outperformed the STI since its inception.
Similar to me, the time for advertisement. So as we're right ahead of this Fed cost cycle, so we should consider using the S-REIT ETF, like our CSOP SRT, to capture the beta rally with the cost efficiency, and that's it.
For S-REITs, I showed the chart earlier that if you invest it over a long period of time, you get 8% total return. If you catch it at the right time, you get 10% or even mid-teens if you really buy from the bottom and sell at the high. So it's an asset class that gives you a very good return, and you know the underlying properties in Singapore. Most of the buildings you know, the managers you know. It gives you a good night's sleep. You can rest on and give you a good return, which probably beat your CPF of 2.5% and fixed D of 3-4% or even less now. So it's a good asset class for you to invest in for the long run.
All right, I think we can come to the close to the end of the session. Well, thank you again for the thoughtful questions and being such an engaging audience. A special thanks to the panelists for sharing their valuable insights. Before we conclude, just a quick reminder that once again, you can participate in the SGX campaign that Tiger Brokers is offering 0 commission in the SGX market till the end of October, with a chance to win a staycation at Fullerton Hotel and many more attractive prizes. On behalf of SGX and Tiger Brokers, thank you all for attending. We hope you find the seminar informative. Have a great evening. We look forward to seeing you in the next future events. Thank you.
Thank you. See you guys.